Hello, my name is Leanne Lubbock and I'm with Freeman Benefits. We help administer the employee benefits that are offered to you by your employer. We've put together this brief presentation to help you better understand the benefit options that are available to you to enroll in. We hope that the information we are going to discuss today will help you get ready to make your employee benefit elections for the year ahead. This presentation is designed to help you evaluate your coverage options and compare the plans and costs. So let's get started. The different benefits that are available to you are medical, dental, vision, voluntary life and AD&D, basic life and AD&D, short-term disability, voluntary long-term disability, and a flexible spending account, otherwise known as an FSA. We understand that for many people, satisfying your family's health care need is the first thing you look for in your benefits package. We are pleased to inform you that we will continue to offer excellent medical coverage through the Blue Cross Blue Shield of Texas plans for 2020. There are two medical plan options that we are going to discuss today, and a few important policy terms that are important for you to understand. So first, let's talk about how the PPO program works. When you have a PPO or a preferred provider organization, you pay less out of pocket if you use physicians, hospitals, and other healthcare providers that participate in the PPO network. Now, you do have the flexibility of using the services of providers that are out of network, but when you use an out-of-network provider, your costs will be higher. You may have to pay the doctor directly or even file the claim with the PPO plan yourself to get reimbursed. In some instances, Blue Cross Blue Shield of Texas must approve the need for care before you seek it. Now, this can be said for both the in and out-of-network providers. So what does it mean to stay in network? In-network providers have agreed to your carrier's negotiated rates. An out-of-network provider may charge more than the carrier is willing to pay. So because of this, you have an out-of-network deductible that is much higher than your in-network deductible. Check with your carrier to be sure that the doctors, specialists, labs, and pharmacies and the hospitals are in the network before you receive treatment. Now, what do I pay after I've met my annual deductible? Well, after you've met the annual deductible, generally you'll continue to pay your coinsurance or your cost share of your in-network covered medical services until you meet the out-of-pocket maximum. Each plan has a predetermined out-of-pocket maximum, which is the most you'd pay for covered medical expenses in a calendar year. Once you've met it, the plan will pay the full cost of additional covered expenses. Medical plan option 1 is a PPO medical plan that is HSA eligible. An HSA or health savings account is a special type of tax advantage savings account designed to help you pay your out-of-pocket medical expenses when you have a high deductible health plan or an HDHP. Money in the savings account can help you pay expenses like the deductible, co-pays, and coinsurance. It can even be used to pay for medical expenses that may not be covered by your health plan. Contributions are made into the account by the individual and or by your employer on a pre-tax basis and are limited to a maximum amount each year. Once you meet the calendar year deductible under your plan, the health insurance pays the remaining covered expenses in accordance with the terms and conditions of the plan. Now, some advantages of an HSA plan are that they're tax deductible. The contributions made to your HSA account are 100% deductible up to the legal limit. In 2020, the contribution limits have increased. For individual coverage, you can contribute $3,550, or for family coverage, you can contribute $7,100. Now, these amounts do include contributions from your employer. Employees age 55 and over can make an HSA catch-up contribution of $1,000. Now, Sempri Advent and Packaging Service Company will contribute annually to your HSA account. They will contribute $600 for employee-only coverage or $1,100 for employees that enroll one or more dependents. So that's money that they're going to put into your account each year. They are broken down by pay periods, but those are the total amounts per year. Now, health savings accounts are also tax-free. Withdrawals to pay qualified medical expenses, including your dental and vision services, you can pay for those services using your HSA account and they are never taxed. HSA monies are also tax deferred. Interest earnings accumulate tax deferred, and even if used to pay for qualified medical expenses, are tax-free. HSA money is yours to keep. So unlike the FSA or the flexible spending account, which we're going to talk about in a few minutes, unused money in your HSA account isn't forfeited at the end of the policy year. It continues to grow and accumulate interest tax deferred. So it's your money to keep. You do not lose the HSA money at the end of the year. It actually rolls over from year to year. Okay, now let's look at how Medical Plan Option 1 actually works. For in-network services, you would be subject to a $5,000 deductible for individual coverage or a $10,000 deductible for family coverage. Once you've met that deductible, you've also met your annual out-of-pocket maximum. Once that happens, then the plan pays 100% of all covered expenses. So there are no co-payments on this particular plan. Once you've met that deductible, then the plan kicks in. So you would be responsible for all of your services up to that out-of-pocket. So your maximum exposure under this HSA Plan Option 1 is just $5,000. Now, if you happen to go out of network, it increases your out-of-pocket exposure. Out-of-network services are subject to a $10,000 individual deductible or a $20,000 family deductible. Once you've met those deductibles, then you're going to fall into what's called coinsurance or cost sharing. Now, this plan pays 70% once you've met that deductible, but you're going to be responsible for 30% of the charges until you've hit an out-of-pocket maximum of $20,000 for individual coverage or $40,000 for family coverage. So it's very important to make sure before you receive services that your providers are in network. If not, you're going to spend a lot more out of pocket. Now, let's not forget that under Plan Option 1, you're subject to, you're going to receive actually contributions. So contributions into your HSA account are made annually. They are made per pay period. For those of you that enroll in employee-only coverage, you're going to receive $600 from the company directly into your HSA account. Pre-tax dollars go in there. And if you happen to enroll one or more dependents onto your medical plan, then you're going to receive $1,100 into your health savings account. You can also make those contributions via payroll deduction. They can go into your HSA account. And those are the funds that you're to use to help pay for all your medical expenses until you hit your out-of-pocket maximums. Okay, now let's talk about Medical Plan Option 2. It is also a PPO plan, but this plan is not eligible for the HSA account. Under this particular plan, for in-network services, you would be subject to a $2,500 individual deductible or a $7,500 family deductible. Once you've met that deductible, you would fall into the coinsurance or the cost share, and this plan has an 80-20 split for in-network services. So what that means is once your deductible is met, you'll pay 20% of the charges until you've reached your annual out-of-pocket maximum of $5,500 for individual coverage or $14,700 for family coverage. Now, this plan does have co-payments for in-network services. Your primary care visits would cost $30 and your specialist visits would cost $60. Now, it also has co-payments for urgent care and ER visits. For an urgent care facility, you would have a $75 co-payment, and for emergency room services, it's a $500 co-payment plus 20% of the charges. But again, it's only going to be until you've hit that annual out-of-pocket maximum of $5,500 for individuals or $14,700 for family. Your prescription drugs under this plan also have co-payments, and there are 6 different levels of drugs under Blue Cross. Preferred generic drugs receive a $0 copayment. Non-preferred generic drugs receive a $10 copayment. Preferred brand name drugs have a $50 copayment. Non-preferred brand name drugs have a $100 copayment. Preferred specialty drugs are a $150 copayment, and non-preferred specialty drugs would receive a $250 copayment. Now, if your medication costs are actually lower than these copayments, you would pay the lesser amount. Now, if you happen to go out of network under this particular plan option, you would be subject to a $5,000 individual deductible or a $15,000 family deductible. Once you hit those deductibles, then you go into the cost sharing, and this is a 60-40 split for out-of-network services. So you're going to be charged 40% of the charges until you've hit a maximum annual out-of-pocket of $11,000 for individual coverage or $33,000 for family coverage. Your regular office visits, if they happen to be out of network, it's straight coinsurance. So what that means is you're going to pay 40% of the charges. Urgent care facilities would also charge you 40% of the charges. Emergency rooms for true emergencies actually are treated exactly the same as the in-network, so it's a $500 copay, and then you pay 20% of the charges until you hit your annual maximum. Prescriptions are a little bit higher if you go to a pharmacy that are out of network. So I encourage you to be sure that the pharmacies that you're using are actually preferred providers or preferred pharmacies with Blue Cross. Those are the best ways to make sure that you're going to pay the least amount. Okay, here I have both of the medical plan options side by side so I can show you a couple comparisons. Now, I only have the in-network benefits shown here because we already know that going out of network is going to cost you a lot more. So we're always going to want to try to stay in network with our providers whenever possible. Now, here you can see the differences in the deductible, but what I really would like to point out to you is your annual out-of-pocket maximum. Now, on the HSA plan or plan option 1, it has a $5,000 annual out-of-pocket for individual coverage and $10,000 for family coverage. Under plan option 2, it's $5,500 for individual coverage or $14,700 for family coverage. So your overall out-of-pocket exposure on plan option 2 is higher than the plan option 1 HSA option. Not only is your out-of-pocket maximum going to be higher under plan option 2, but your biweekly payroll deductions is also more. So please keep that in mind when you're factoring in which plan works best for you. Now, a couple of other helpful tips that I wanted to talk about are the differences between urgent care facilities and emergency rooms. Now, these little standalone buildings are popping up everywhere. Standalone urgent care, standalone ERs. So even if the ER is not attached to a hospital, they are going to charge you those higher co-payments or higher charges, just like they would if it were attached to a hospital. True urgent care facilities that are in network are going to cost less, and the wait times are also going to be lower for you. The only downside to urgent care facilities would be their hours of operation. Many of them are only open during regular business hours. Now, if your emergency is a true emergency, it's life-threatening or perhaps loss of limb, then you're definitely going to want to go to the emergency room. But just please keep that in mind that urgent care facilities can be a good alternate for care in some of those urgent situations that may not be quite as life-threatening as other reasons you might go to the emergency room for. Another thing I'd like to point out is the prescription drug costs. So under plan option 2, we have co-payments, we have set dollar amounts, we know what our drugs are going to cost. Under the health savings account, you're going to pay 100% of the cost of the medications, but everything again is going to go towards meeting your out-of-pocket maximum. So what I'd like to encourage everyone to do is use a resource called goodrx.com. You can go online, you can pull up your medications, and you can see what the cash price is for those medications, and you'll be quite surprised. Many of them are going to actually fall in line with what a co-payment might be under an actual medical plan. Sometimes it's going to even cost less than your co-payments. So be sure if you're on any kind of maintenance medications and check the actual cost. Don't let the fact that there's no co-payments under this HSA plan deter you from electing this plan. A lot of those costs are set. You can go to goodrx.com, or there's also many discount programs with manufacturers as well. You can print out the little coupons online, take those to your pharmacies, and receive those lower costs. Now again, side by side here, we have the difference in the biweekly payroll deductions for each plan. And let's not forget that the company provides you with a $600 contribution to your HSA account for employee-only coverage. And then if you elect coverage for one or more of your dependents, you would receive a contribution of $1,100 annually. Now here I have an example of how the HSA option helps save you money. Now for this example, we're going with the employee-only comparison here. So we're going to look at the differences in cost. Now the employee annual plan cost for plan option 1, which is the PPO option with the HSA account, your cost would be $1,211.08. Plan option 2 would cost you $2,077.14. So plan option 1 gives you a savings in premium of $866.06 for the year. Now the company is going to contribute $600 to your health savings account. And then if you, the employee, were to put away $1,000 into that health savings account, which is about just under $40 per pay period, you would reduce your taxable income, therefore saving on your federal income tax, a tax savings of about $352 annually. Now, if you were to contribute more to your health savings account, obviously those savings would be greater, but for this example, we're just going to look at $1,000. Now, that's a total savings for you of $1,218.06 by electing plan option 1 versus plan option 2. Now, for more information about each of the different plan options, you can review the summary of benefits. Now, the summary of benefits, or SBCs, summarize in a standard format important information about the health plans that are offered to you by your employer. This is just another resource to help you make choices about your care and compare the different plan options. I'm going to show you a little bit later on in the presentation where you can find those summary of benefits to review for each of the different plan options that are offered. Now, the next benefit that we're going to go over are the flex benefits, or FSA. Flex benefits are another option that you can elect to help reduce your federal income taxes and increase your monthly spendable income. Employees must re-enroll for this benefit each year. All employees are eligible to enroll in the FSA benefits, even if you are not covered by the company medical plan. You can use your flex benefits to pay for current year eligible medical expenses, dental expenses, vision, or even child or elder care expenses. Employees make an estimate of what their eligible expenses will be for the year ahead. Then that amount is deposited into their FSA card. Employees then use their FSA card to pay for those eligible expenses throughout the year. The funds are then paid back to the company via payroll deduction on a pre-tax basis throughout the year. There are 3 different options for employees to elect under the Flex benefit plan. The Flex option allows employees to pay for medical, dental, and/or vision expenses. Employees can elect up to $2,750 under their FSA with a minimum of $130. Now, this Flex benefit is not available if you elect the HSA plan, or plan option 1. Now, for those employees that do elect the HSA account, you can do what's called a limited purpose FSA healthcare account. This allows employees that elect the health savings account plan option to utilize their FSA funds to pay for dental and vision expenses only. Under the limited purpose FSA, employees can elect up to $2,750 for this benefit, and again, there is a minimum of $130. Now, you can also choose what's called the Flex Child or Elder Care Expenses account, and this allows employees to pay for child and or elder care expenses out of their FSA account. Now, employees can elect different amounts under this particular option. If you're married filing jointly or as a single parent, you can elect $5,000 to your FSA. Or if you're married filing separately, you can elect $2,500 to your FSA. As I mentioned a few minutes ago about the FSA, you do have to re-enroll in that each year. So during open enrollment, we'll have you complete an application to determine how much you want added to your FSA account. And then you'll also complete an application for the debit card or the FSA card. Funds are then placed on that card, and that's how you would pay for your eligible expenses. One important thing to make sure you know the difference between your FSA money and your HSA money if you happen to elect the medical plan option 1. HSA money is an account that is controlled by you. You don't lose the HSA funds. They roll over from year to year. But FSA funds are controlled by the employer. They basically make those funds available to you immediately, and then you have the entire calendar year to spend those FSA funds on eligible expenses. At the end of the year, if you don't use all of your FSA funds, then you would lose them. There is a small amount that rolls over from year to year, but you definitely want to try to utilize all of those funds in the calendar year. If you find yourself at the end of the year in December needing to spend more of your FSA funds, there's a website called fsastore.com that has all kinds of items that are all eligible expenses. So that's one great resource that you can use to get those FSA funds spent before the end of the year. Okay, now I'd like to talk a little bit about the dental benefits that are offered. The dental benefits are offered by Principal. This is a PPO dental plan, so it does allow you to go to both in and out of network providers. Just like with your medical insurance, though, you're going to want to try to stay in network with your providers whenever possible so that you can maximize your coverage. Now, this plan has a $1,000 annual maximum benefit. So that is the most that this plan is going to pay, and that is per person that's covered by your dental plan. But basically you have $1,000 worth of dental bucks, if you will. There is a $50 individual deductible for basic and major services. If you happen to have family coverage, you would only be subject to a total of 3 deductibles for the year. Preventative services are things like cleanings and your annual exam. You get 2 of those, one every 6 months, and those are covered at 100%. Basic services would be covered at 80%, so basically you're going to pay 20% of the charges, and the plan would pay 80% of the charges. But again, the plan's only going to pay up to the $1,000 annual maximum. And basic services would be things like simple fillings. Now, major services are covered at a 50-50 split. So the plan pays 50%, you pay 50%, but again, only up to that $1,000 annual maximum. Major services would be things like root canals, crowns, dentures, things along those lines. Now, this plan does have a child orthodontia benefit. It's a $1,000 lifetime maximum benefit for children under the age of 19 for orthodontias or braces. There is no adult ortho on this plan. For more of a breakdown on all of the different services that are covered by the dental plan, you would want to review the full summary of benefits. It will provide you with a breakdown of what is considered preventative, what is considered basic, and what is considered major services under this plan, as well as provide you with some of the exclusions under this plan. Employees also have the option to elect vision benefits. The vision benefits are also administered by Principal, and coverage is provided by VSP. VSP is one of the largest vision care providers in the country, and it's one of the easiest vision care coverages to utilize. Principal does send out ID cards for both the dental and for the vision benefits. But for your vision benefits, when you're calling and making your eye exam appointments, you can just let them know that you're a VSP member, and they can actually pull your benefits just by your name and social security number. Now, under this vision plan, exams are covered for a $10 copayment, and you are entitled to get one exam every 12 months. And they do stick to that. It's every 12 months exactly. So you don't want to go in less than 12 months to your second exam. It won't be covered. Prescription lenses are going to be covered under a material copayment of $25, and new lenses are going to also be covered every 12 months. And that's going to cover things like single vision, line bifocals, line trifocals, and lenticular lenses. Polycarbonate lenses for dependent children under the age of 18 are also going to be covered under that $25 copay, but then there are some additional lens coatings and enhancements that your vision provider is going to charge extra for. But because you're a VSP member, you're going to receive a $20 to $25% additional discount on some of those different enhancements. Now, under this vision plan, frames have a $150 allowance. So if you can find frames for $150 or less, they are going to be covered by the plan under that $25 material copay. Now, if you find some frames that cost a little bit more, any amount that those frames cost over the $150 allowance, you're going to receive a 20% discount on. And new frames are going to be covered once every 24-month period. Now, if you would like to do contact lenses in lieu of glasses, that will be covered. This plan will pay up to $60 for elective lens exams. Now, that includes the exam and the fittings. And then there is a $150 allowance for the elective contacts. If you decide that at your appointment that you want an additional pair of glasses or maybe some sunglasses, there are discounts for those if you purchase them the same day. There are also some discounts if you go back to the same provider within 12 months and purchase those additional glasses. This plan also provides some discount for laser vision correction. Members receive an average of about 15% off of regular prices or 5% off of promotional prices when you utilize a VSP provider. Now, your vision plan does have benefits for out-of-network. However, they're very limited. You do have to submit your own claims for out-of-network benefits, and then you have to wait to be reimbursed for out-of-network. So you definitely want to try to stay in-network whenever possible when utilizing the vision plan. Another coverage that's available for employees to choose from is the voluntary life and AD&D coverage. This program is also administered by Principal. So when employees are first eligible for benefits, those employees that are under the age of 70 may elect up to $100,000 in voluntary life coverage without answering any medical questions. So that's a guaranteed issue amount of $100,000. Now, you do have to enroll when you're first eligible to get that amount without having to answer those medical questions. And I'm going to talk a little bit about your other options here in just a second. But those employees that elect coverage on themselves can then purchase coverage for their spouse for up to $30,000 without answering any medical questions. And you can also elect coverage for your children up to age 26. Now, the child coverage is either a $5,000 or $10,000 increment of coverage, and it does cover all of your dependent children for one flat rate. Employees can actually choose to purchase up to $300,000 in voluntary life coverage for themselves or up to $50,000 on their spouses. Now, if you're electing these higher limits of coverage, or if you elect this voluntary life coverage after your initial eligibility period, you will be required to answer a few medical questions on a statement of health form or an SOH form. Now, once you complete those medical questions, we'll submit that to underwriting, and then they would review it, and you would have to be approved for those higher limits of coverage. Now, you may be asking, what's my initial eligibility period? Well, when you're a new hire and you're first offered these benefits, If you don't elect them initially, then you're going to need to fill out the statement of health coverage if you purchase them at open enrollment or a later year. So basically, all of you current employees, if you did not elect in this coverage last year or the year before when it was first offered, you still have the option to purchase those benefits, but you do have to complete the statement of health form. Or maybe you bought coverage last year, but you want to increase it this year. That would be another reason why you would need to fill out that statement of health questionnaire. Now, spouse coverage cannot exceed 100% of the employee coverage, so you cannot cover your spouse for more than you cover yourself. Voluntary life coverage does include accidental death and dismemberment for the employee and for the spouse. This doubles your benefit in the event that the loss is due to an accident or an injury. The voluntary life benefit is portable, which means that should your employment terminate, you may be able to convert your benefits to an individual policy. Members must contact Principal directly within 30 days of your termination to request the conversion option. This plan provides an accelerated death benefit, which means that it allows members that become terminally ill to receive a portion of their life coverage in a lump sum. Now, benefits do reduce by 35% when the employee or spouse turn age 65, with an additional 15% reduction at age 70. And the voluntary life coverage is paid for via payroll deductions. Now, rates for this coverage can be found inside of your employee benefits guide, and they're also calculated for you in ADP. Now, when you go in to process your enrollments in ADP, it should flag you. So if you were originally eligible and you go in to elect this coverage, it's going to tell you that you need to fill out the statement of health form. So just know that if that flags up, there's usually a reason as to why those statement of health need to be completed. If you're newly eligible and you don't feel that you need to fill that out, check how much coverage you're applying for, because again, if you apply for more than the guaranteed issue amount, you will also need to answer those medical questions. Now, all eligible full-time employees will receive a $20,000 basic life and AD&D benefit at no cost. This is an employer-paid benefit. It's also administered by Principal. Coverage does reduce on this plan as well by 35% when the employee reaches age 65, and it will reduce again 15% when the employee reaches age 70. If the loss is due to an accident or injury, the death benefit does double under this plan as well. If the member becomes terminally ill, they may be eligible to receive the portion of this life benefit in a lump sum. And just like with the voluntary life, if your employment should terminate, you may be able to convert this life policy to an individual policy. But please remember that the employee must contact Principal directly within 30 days of their termination to request that conversion option. Another benefit that all full-time employees will receive is a short-term disability coverage at no cost. This is an employer-paid benefit. It is also provided by Principal. Now, the short-term disability plan pays 60% of your pre-disability earnings up to a $1,000 weekly benefit. Benefits begin on the 8th day if the disability is the result of an accident, or on the 15th day if the disability is due to a sickness. This benefit is payable for up to 12 weeks. Now, the last benefit that we're going to talk about is the voluntary long-term disability, which is also provided to you by Principal. All full-time employees have the option to enroll in this voluntary long-term disability program. Now, long-term disability pays 60% of your pre-disability earnings up to $6,000 monthly. Benefits begin for the long-term disability after 90 days. So this plan is designed to coordinate with the short-term disability plan. So if you need to protect your income past that 12-week period that the short-term disability will cover, you would want to consider enrolling in this voluntary long-term disability plan. Now, benefits are payable up to age 65. However, your age at the time that the disability occurs does determine the length that you are eligible to receive benefits. So for those folks that are in the age bracket of 62 to say 69, well, you would have an actual schedule that would show you how long the benefits are payable to. and that's located in the full summary of benefits. Now, there is a pre-existing condition exclusion that does apply. This plan looks back 6 months for pre-existing conditions, and disabilities that occurred during the first 12 months of coverage due to that pre-existing conditions may not be covered. Now, coverage for long-term disability is paid for via payroll deduction, and the rates for this benefit can be found inside of your employee benefits guide, and they're also calculated for you in ADP. So rates are going to be dependent on your current salary information, so they may vary from employee to employee. All employees will receive access to the Employee Assistance Program, or the EAP program, that is administered by Principal. Coverage is provided by Magellan Healthcare. The EAP program provides employees and their immediate families with access to free, confidential resources to help handle everyday and not so everyday challenges. The services for you and your family include LifeMart Discount Center with savings on a variety of products and services, self-assessments for identifying issues with stress, depression, or even substance abuse, health and wellness articles, guides, webinars, and podcasts, and even calculators, online assistance with elder care, child care, and other family life resources. There's help with teen and adolescent issues, including eating disorders and relationships, tips for parenting and grandparenting, and 24-hour-a-day, 7-day-a-week phone consultation with licensed mental health professionals and referrals to supportive resources. Now, I've mentioned a couple times during this presentation about summaries of benefits, plan summaries, and the employee benefits guide. Now, everyone should have received by email a copy of the employee benefits guide. Inside this packet of information, we have a contact information sheet that has phone numbers and web addresses for the carriers, group ID numbers. It has my contact information in there. It's a very helpful resource to refer back to during the year should you ever need assistance. If you don't happen to save that, what we have done new this year is set up an employee benefit document site, which we can share that link at any time. Feel free to contact me if you need it. Here we've basically housed all of the different documents that are included in the employee benefits guide, and we've made them very easy to access. So basically there's different tabs across the top of the website itself. So if you wanted more information on, say, your medical plan or Blue Cross Blue Shield in general, you would click on that medical tab and it would take you to some help sheets and some tip sheets. Things like the mobile access with Blue Cross, or how to enroll your membership online so that you can access your claims information. We have all sorts of helpful bits and pieces of information located on this new document site. But again, the employee benefit guide or the document site are two really great resources to review and understand more about each of the different benefits, and it's a great place, either one of those, to refer back to should you ever need to. Well, this concludes my presentation for today. Thank you so much for listening in. Again, my name is Leanne Lubbock, and I'm with Freeman Benefits, and we help administer the employee benefits at Packaging Service Company. I am available to help throughout the year, so if you ever have any questions about your coverages, need help with some claims, please do not hesitate to reach out and give me a call. I'd be happy to help. I've included my phone numbers here on the screen. They are also provided for you inside of that employee benefits guide, so please don't hesitate to use them. Thank you so much for listening, and I hope you have a great day.